Good afternoon. Today is May 2nd, 2008. This is Greg Wolf from Options University, an Options University strategist, with your weekly market recap, where I'm going to go over day by day exactly what happened in the U.S. equities markets, financial markets, and give a short recap and review as far as what moved the markets from a macroeconomic standpoint, as well as technicals, and we're going to go over a little bit of option theory as well. We started out the week lower than we are now. We definitely, as you can see by the charts, have moved up from the week starting on April 28th. Monday we began at 12,891 in the Dow Jones Industrial Average. As of right now, 12 minutes to 4, we're looking at 13,035. The S&P 500 started the week at 1397, and right now I'm seeing 1411. And the Nasdaq Composite Index began the week at 2422, and we're adding some buyers there to bring us to 2470. Most of that, a majority, as you can see, took place yesterday with the what seems to be the current or the recent modus operandi of the markets. The next day after a Fed decision, you tend to see the opposite of what took place the day before. Wednesday we did have that 25 basis point cut in the Fed funds rate, as well as 25 point cut in the discount rate. Subsequent to that decision, there was quite a bit of selling, as you can see from the chart here, signifying the Wednesday's trading activity, with a large trading range back to down on the day in all the major averages. But then the following day we did see quite a bit of buying. Now it's interesting to point out that the magnitude of the purchasing on Thursday was, even in the face of disappointing earnings results from ExxonMobil. As we will look here, Exxon came out before the bell and announced their results. We can see this gap here. They announced $2.03 per share versus $2.13 expected for Q1. And more interestingly, said that guidance for future margins in global refinery revenue looked like they were going to be decreasing. So the stock traded off quite significantly there, bringing down the OIX and the OSX with it. And of course, Exxon is a Dow component, major Dow component, and yet the Dow shrugged that off and still added quite a bit in way of gains yesterday. If I can go through the week, April consumer confidence came out on Tuesday to start the week of economic news, with a 62.3 number versus 61 expected. Then the next day, the big news was Wednesday, the gross domestic product for Q1 remained at 0.6%, the same level it was last quarter, versus 0.5% expected. So I guess in technical terms, we're not in a recession, because of course that means 2 consecutive quarters of negative growth. But I have a lot of people that would argue that point, so you may think that the definition for recession has kind of changed here a little bit, especially in the retail sector and the consumption and the earnings cycle that we're seeing, the earnings numbers. April, Chicago's PMI came in at 48.3 versus 47.5 expected. Now, although that did beat the numbers, that still is in a retractionary level below 50. Then, as I alluded to earlier, the Fed cut the quarter point in the Fed funds and the discount rate on Wednesday. We did see buying going into that decision, as has been the recent expected activity, and then afterwards, there was that sell-off. Thursday, we saw March PCE core inflation rising to 0.2% versus 0.1% expected. So once again, we do see an increase in the level prices of goods. That is most being seen in the energy sector still, with oil flirting with $1.20 per barrel. $120 per barrel all week. The difference there of late has been the correction, or the lack of bullish activity in the metals. And as we see here, looking at the gold mining index, we have seen a sell-off in the metals that you could speculate that has something to do with selling by the central banks, or it could be the fact that hedge funds have been forced to deleverage some of their positions in the metals and by the prime brokers, forcing them to seek out other opportunities elsewhere, thus rendering some sales there. To revisit what happened today, Friday, the non-farm payrolls for April came out this morning, and we saw a loss of 20,000 jobs versus the loss of 75,000 that was expected. And the factory orders for March came out after that with a 1.4% number versus 0.2% expected. So once again, we see these ambivalent numbers: growth, no growth, retraction, and expansion. It's really a difficult market to trade right now. If you look at the volatility index, which we can bring up right here, it seems like there really isn't anything to fear. We're down at 18.44 in the VIX, and the last time that we saw that number, if we can look right here, was December 24th. And we all know what happened in the month of January. So I don't know what that could possibly portend, but if you want to look at the month of January in the Dow, or the S&P we'll use, that's where we were when the VIX was this low, right about there. So we saw quite a bit of a sell-off in the major indices after that time, after that period, and here we are again with what appears to be cheap volatility, and not many people being very worried to the downside. Apparently, many people are expecting this to be a nice, tight and tidy double bottom right here. From a technical aspect, I would have to say that we've breached a couple of levels here. It looks like the 500-day moving average was breached in the S&P 500, although not greater than the 3% whipsaw that I personally use. And the Nasdaq Composite Index, also we see it breach the 500-day simple moving average right here, with the 200 to deal with now. And the other issue we have from a technical level is the Dow Jones, which just recently got over the 200, although it's trading below it right now as we speak. Looking to go out on the day, it looks like up just a little bit, up 31 points at 13,041. Okay, that's about all the time I have. This is Greg Wolf with Options University Strategist, and I will talk to you next week.